Contagion. The definition in economics and finance is contagion can be explained as a situation where a shock and peculiar economy or a region spreads out and affects others, like something going from Europe to America. Stocks today, though, held up pretty early. In fact, we were consolidating Wednesday's move when a report circulated that hedge funds had begun to cut their ties with Deutsche Bank. Meanwhile, the bank continues to voice confidence. It says it's going to weather this storm and it won't need any government intervention. But we heard all of this before. Remember back in 2007 when none of those Wall Street giants needed help until they did. Well, the street had to put on a brave face then, and it's been putting on a brave face lately, too. But with respect to contagion, should this giant German bank go through an even deeper crisis, it's going to be worrisome. We saw today's knee-jerk reaction. It proves that beneath the calm, there are memories of Lehman. There's memories of Bear Stearns and how our own banking system collapsed. With Deutsche Bank hitting another all-time low, it's becoming harder to see how the bank, this bank in particular, will be able to pay a fine that is now equal to its market cap. Now, I don't see the same risk. They do not mirror those of 2008, but I will say we shouldn't whistle past a graveyard either. Now, central to these concerns are systemic risk with hedge funds being involved in derivatives. We know that's a big fancy word. These things are complicated. It's sophisticated. It's an area of investing that, I got to tell you, it seems like a gold-plated time bomb. Of course, now one of the reasons that these pharaohs of Wall Street love derivatives, they're not making money in the stock market anymore. Hedge funds, in fact, have underperformed for 7 years, and most recently posted results that look like old CD returns from community banks. Hedge funds typically charge 2% as an administrative fee, and they demand 20% of profits for their expertise, whether you're an individual investor or institutions. Well, these people have been having second thoughts. You know, last year, almost 1,000 hedge funds had to close their doors. That was the most since 2009. And this year, well, investors aren't waiting for these managers to pull down their shingles and return funds. They're just simply moving money away to what's known as passive funds. Through July of this year, over $200 billion have been pulled from these active hedge funds, $163 billion poured into passive funds. As for exposure to large U.S. banks, right now there's no doubt the industry is much better positioned through stronger capital ratios and, by the way, being able to dump all that toxic debt on the Federal Reserve. So I think they could withstand a tidal wave of bank failures out of Europe. So even though the stock market tumbled into the close, I'm not panicking right now. In fact, I love the action on Caterpillar. I told you about the stock last night. And then there's a potential takeover of NXPI. It's a making money favorite. I've mentioned it on this show many times over the last year. Huge potential in technology. Keep all that in mind.